Well, hello everyone, and welcome to the Alamo Mortgage Holdings webinar. My name is Benjamin Z. Miller, and I am the Managing Director of Alamo Mortgage Holdings. Today, we've got a really exciting webinar for you about how you can earn passive income long-term by purchasing Alamo Mortgage Holdings bonds. We are a United Kingdom company, and we offer a bond to UK accredited investors and to also institutional investors. And what we do is we purchase packages of mortgages. We purchase American mortgage debt. But before I go through the presentation, I'm going to first read a legal disclaimer, and then we'll get to the fun part of the presentation. So, all right. So as accredited investors, you will be aware that all investments carry some level of risk. This investment is only available to investors who are able to assess their own appetite for risk. Please read the risk statement within the investment memorandum before investing. All right. Well, fantastic. So now let's look at the financial product that we offer. We offer 8% passive income, and we do this with a fixed income loan note. So you invest with Alamo Mortgage Holdings and you get 8%. We suggest an investment of £100,000, but you can do a lesser amount if you're just getting started with us. This is ideally designed for someone that is looking to build passive income over a period of years, where maybe they get on an annual investment program with us, where each year they might invest, for example, £50,000 for a few years or £100,000 for a few years to build up. Or if you're an institutional investor and you're looking to place a larger amount of capital, we can absolutely support those larger placements. The term of the bond or the loan note is 3 to 50 years, and the security is a debenture over our company and all assets. The team that works for you has 200 years of business experience, with 100 years in the mortgage and real estate industry in Texas. We handle all of the collections. We do all of the collections on the mortgages that are purchased in the United States. And we also offer 100% money back guarantee on any non-performing notes. We actually take those out of the portfolio. You can invest with multiple currencies. You can invest with British pound sterling, US dollar, euro. We're easy to work with. So let me tell you about the team. First, we'll start with myself. Our team has 200 years of experience, 100 years in the mortgage and real estate industry. Our team has, members of our team have worked with clients including Microsoft, Chevron, Exxon, EventBrite, and Fora Financial. As for myself, I'm a businessman from the United States. I'm a U.S. citizen. And prior to founding Alamo Mortgage Holdings, I focused on real estate and mortgage note investing in the U.S. I purchased a multi-million-dollar portfolio of commercial and residential assets. I later was active in private business acquisitions in the US and Europe, and I have founded several startup companies, and I just have a background in international business. I'm also the director of an emerging market bond fund, and I'm on the board of various companies throughout the world. My business philosophy is really summed up by the phrase, every problem has multiple solutions. So very good. I graduated from the University of Colorado at Boulder, double major economics and Russian studies. We have another team member, Marina Zaharelska. She is our international investment coordinator, and she speaks several languages. She is so talented. She speaks English, Italian, Spanish, along with her native Ukrainian and Russian. And she really enjoys taking the time to get to know each of the clients she works with, to make sure their passive income and investment timeline goals are accurately communicated to the Alamo Mortgage Holdings team. She graduated with a degree in international relations from the EU Business School in Barcelona. We have Scott Wynn. He is a a veteran note buyer, a very experienced note buyer. He has 30 plus years experience buying owner financed real estate notes, residential and commercial loan originations, collections, buying, repairing, and selling houses, in bulk REOs were when a bank takes ownership of assets, and non-performing note portfolio purchases. So he really brings a lot to the team in terms of experience in the industry. We have Fred Hobbs, and he's the director of mortgage servicing. He's located in San Antonio, Texas, and he's actually a licensed mortgage originator in the state of Texas since the year 2000. He's the founder and president of Texas Mortgage Capital. And he has originated thousands. Texas Mortgage Capital, his company, has originated thousands of private money residential notes. He's originated thousands of loans for seller finance investors and private investors in both residential and capital markets. And his company, Secure Net Loan Servicing, is really first rate. Secure Net Loan Servicing is such a great company. I cannot speak about them highly enough. They do all of the servicing for Alamo Mortgage Holdings. All of the notes, we place those with Secure Net Loan Servicing, and then they make sure that the taxes and insurance and all of the payoffs are kept track of accurately. We have David Jones. He is a licensed attorney in the state of Texas. He's actually a third-generation attorney. David, he entered the Texas title industry in 2004. He spent 10 years as a title examiner, claims attorney, and he worked closely with title agency underwriters. He's someone that helps us when we are acquiring a package of notes. He actually looks over all of the legal paperwork. He drafts the legal paperwork and helps us with making sure that we are in a good position. We have Anna Kulikova. She's a specialist with investor relations, and she works with investors that are interested in learning more about Alamo Mortgage Holdings. She's originally born in Russia. She speaks English, Russian, and Ukrainian, and she works with investors to just answer their questions about Alamo Mortgage Holdings and how it can generate passive monthly income for them. We have Mark DeRuyter. He's our Chief Technical Officer. Mark is a software architect, but he has many years of experience actually designing mortgage software, a lot of the commercial mortgage software that is out there. And there's a possibility that if you've ever seen some of these amortization calculators on calculating payoffs on mortgages, particularly those that you might find at larger institutions, banks, this sort of thing, he may have been involved in creating some of those. So he brings a lot of experience with that sort of software, the financial services software. Okay, let's talk about the financial product. The financial product is you can invest in our Texas mortgage notes, and you can earn a passive income of 8%. We set the annual rate once a year. We have chosen 8% this year. Next year we'll make another decision on what the long-term rates are going to be, but for this year it's set at 8%, so you can lock in that high rate of interest for anywhere from 3 to 5 to as long as 50 years. That 50-year product is more often looked at by institutional investors that are wanting to improve the duration, to adjust the duration of their portfolio, but we do offer that. And it's also available to individuals. If you're looking for a long-term income stream, that is a great way to do it. Okay, so let's talk about why do so many UK investors still purchase gilts? And for those of you not from the UK, a gilt is a government bond in the UK for passive income. And are UK gilts still worthwhile during high inflation and a weakening British pound? So I'm just going to play a clip here where we talk about that. Now, let me go through this here. If you're looking to purchase gilts, let's say you're looking around and you've bumped into this video and you're looking to purchase gilts, you probably are in the situation where you want a reliable way to obtain passive income, and gilts would fit this requirement. The problem with gilts, though, is they are denominated in British pounds, and the pound has a decades-long history, a tradition of losing value against the US dollar. Another problem with purchasing gilts is that the returns they offer are lower than corporate income bonds. They're always lower. Interest on all registered gilts is payable gross without deduction of tax. Holders of gilts on the register maintained by CIS may opt to have tax deducted at source by applying to CIS. Gilts, of course, have their merits, and for an investor, this is important. Gilts have their merits, and for an investor that can turn a blind eye to the high rates of inflation. So if you're the type of investor that can see all that high inflation in the United Kingdom and you can just shut your eyes, turn a blind eye and say, I don't see it, that is one of the requirements. The second requirement is if you can also, with your other eye, turn a blind eye to the weakening British pound. If you can just ignore that for decades, your pound has lost value against the dollar. Ever since Bretton Woods, it's lost and weakened against the US dollar. Then if you're that type of investor, then yeah, you can accept gilts and you'll get paid on time and you'll get some passive income and it'll be great. And they're index linked and you can go to sleep and just, you turned a blind eye on both of the problems and hey, everything's good. Yet the fact that gilts are easier to purchase and more well-known does not mean you will earn as much interest. If you were to instead purchase my company, Alamo Mortgage Holdings, we offer a corporate income bond. If you were to purchase a corporate income bond through Alamo Mortgage Holdings, you could potentially earn hundreds of basis points more per year on your corporate income bonds than those old gilts. If you're interested in purchasing a bond, you can contact me directly by emailing ben.miller@alamomortgageholdings.co.uk or call me. I've got a US number, 1 for the United States, and then area code 817-203-4160. We can have a discussion about your passive income goals and also your investment goals. If after that discussion, the product seems suitable for your investment portfolio, you then can sign some paperwork that will be prepared based on the term of the bond you are looking for and some other features. If you currently have British pounds and you want to exchange for US dollars, that's easy to do. We simply handle the conversion for you and then your bond is paid in dollars. At the point it is converted, you have made a dollar-denominated investment and no longer will potentially lose money on the exchange rate if the US dollar keeps rising against the British pound sterling. If you are in the situation where you have pounds and normally would want to purchase gilts, but you're looking at all this inflation and the pound endless. So that is real important to think about the forces that are at work there. So now let's go through it. Basically, we provide passive income to our investors. We might purchase a mortgage note that has a face value of $100,000. We might buy that for $70,000. Let's say it was a $100,000 note that had a 10% rate of interest. We might purchase that note for $70,000. And even though the interest rate is still 10%, because the borrower still has to make the same monthly payment, the yield on that note is now 14.2% because we purchased it for only $70,000. We'll go through a more detailed example later. And we'll also talk about why that interest rate could be so high. Very good. And that is then how we're able to pay out 8% to our investors. Okay, let's talk about what determines the value of a mortgage note. So then what determines the value of mortgage debt? Because we know what determines the value of real estate. Real estate is determined by the value of a particular flat or house. It's determined by what are comparable houses and flats, what do they sell for? That determines the value. If it's a commercial property, it's determined differently, where it's determined by the cash flow on the commercial property. But for this example, if we talk about a mortgage note on, say, a property, maybe a residential home, there's six factors that determine the value of a mortgage note. The first factor is the buyer. So if you had a choice between buyers, say you have a property and you're trying to decide who to sell the property to, and you've got one person that is a government employee, and that government employee has a high salary, they've been working for many years for the government, maybe they work as a post office person, maybe they deliver packages for the post office, and they've been doing this for 10 years. If the government is their employer, you know there's a very high probability they're going to get paid on time. But if you have another buyer that says, you know, I'm 24 years old and I just started my new company and I'm just going to make a bunch of money with my company, and they don't have a regular income, but they have a plan where they're going to make money in the future, that sort of buyer is far less desirable. It's better to sell the asset to one that has regular government income, the government employee, or the one that works at some sort of a big corporation. Maybe they work at Microsoft, maybe they work at Google, maybe they work at some big corporation. That buyer is more likely to be able to pay, where they are not going to have cash flow experiences where the things are up or down. The second thing that determines the value is the collateral. So the collateral means the actual asset. So let's say that the property is worth $100,000. Say that's the market value. That's the real value, $100,000. But say that you had a seller that he sold the property with a note for $200,000. Pretend he found somebody who didn't know the prices, and that person agreed to pay $200,000, even though the market value is only $100,000. You have to treat that note differently, because the fact that he found somebody that signed a note and the asset's only worth 100, but he found someone that signed a note for 200 does not make the note worth 200. You could look at that note and you could base it on the value of the collateral. So that's a mistake, is a lot of times people don't look at the collateral, they just look at the value of the debt. And when they see the value of the debt, they may not have properly analyzed what's the collateral worth. The third factor that drives the value is the down payment, the money that the buyer initially paid. So let's say you had two buyers, one that put 30%, 40% of the purchase price, where if it was 100,000, maybe that buyer put down 30,000, 40,000, 30 or 40%. And then say another buyer said, you know what, I want to buy this. I'll pay you the 100,000, but I only have $1,000. I only can put down 1,000. Can you finance 99,000? And the seller agreed. So they both agreed to buy the asset for 100,000, but one of them put down 20,000. Another put down only 1,000. The one that put down the larger down payment is better, because there's less risk of the person saying, you know what, I don't want this. I'm just going to leave. I'm just going to move. I'm just going to, do, because he's got virtually nothing to lose. He lost $1,000, his down payment. But the one that put 20,000 or 30,000 down, he lost a lot more if he walks away from the deal. So that's why you look at the buyer's equity or their down payment or their upfront money. That's an indication of the value. So a buyer that puts down 10% is better than a buyer that puts down 1%. The fourth thing that's important is the actual interest rate. The interest rate on the note. So if you have a note, if you have a mortgage debt that pays 10% or 12%, that is better than a mortgage note that only pays 5% or 4%. So if you had a choice between two notes, two mortgage debts, and the first paid 5% and the second paid 10%, the one that paid 10% is better. The next factor that drives value is the history of the payments. So when you buy these mortgage debts, you want to look at how long has the person been making payments. You want to be careful buying a new note. You want to see a record of how long the person has been making payments. So if a person has a 30-year note, and they are 4 years into a 30-year note, where they still have 26 years left, that is safer if you see a record of payments compared to a 30-year note that the person put the down payment down, but they haven't yet made their first payment. Because what if the person just walks away? What if they don't make that payment? Then you've bought a note that is a non-performing note. You want to buy a performing note. A performing note is more valuable than a non-performing note, because then you don't have any work to do. You just buy the note, and the borrower makes payments to you. So a performing note is better, and the history of performance is important. The next factor that drives value, the sixth factor, is the actual paperwork, the legal paperwork, if it was done properly. Because if you have a note that was just two guys that were sitting around a kitchen table and they worked out a deal and they wrote it up without a lawyer, where they just wrote up an agreement and they signed it, that is less valuable because the note likely has mistakes. They're not lawyers. They just agreed that, yeah, I'll make payments to you for 30 years. Did they remember to put in any of the legal language? Did they know how to put any of the legal language in? These things are important. That type of note is less valuable than a note that had a proper closing at a legitimate company with legitimate lawyers that drafted the paperwork, because you know that it's very likely that if you buy that note and the borrower doesn't make payments to you, you have legal recourse. You don't want to buy a note that hasn't been drafted properly, that doesn't have proper legal paperwork. So then
that's definitely something that is important. And now let's take a look here at an example. So here's a property. This is a real property in Texas. This is not something that we have in our portfolio. I'm just showing it to illustrate. So the sales price, the asking sale price is $120,000. Imagine what happened was a buyer went to the seller and said, hey, I'd like to buy this property. I'll pay you the $120,000, but I don't have $120,000 in cash, but I can put $20,000 down, and then I can make payments to you for the $100,000. And the seller said, wait a minute, that's not going to work for me. I need all my money. You need to go to the bank. I know a banker named Jim, and you can go talk to Jim, and he's a good banker and he'll get you a loan. So go ahead and let's do it that way. So the buyer went over to the banker, Jim, and said, hey, I want to buy this. Can I have a loan? I've got $20,000 down. And the banker looked at the buyer's credit report, and the banker looked at the fact that he had a low credit score. And he said, no, you can't have a loan. If you've got a good credit score, you can come back and I'll give you a loan. And if you're also self-employed, I don't like making loans to people that are self-employed. Just get out of here. He was friendlier than that, but that's basically what happened. So at that point, what happened is the buyer went back to the seller and said, I talked to the bank, they wouldn't make me a loan because I have bad credit. And because of the fact that I'm self-employed, they don't like making loans to people that are self-employed. But I really want to buy this. I'll definitely pay you the money. Can I just make payments to you?
And the seller at this point wants to sell the property. So he decides, you know what, that sounds okay. And he says, well, listen, I'll let you make payments to me, but I'm not going to loan to you at a low rate of interest. It's going to be 10%, not a bank rate of interest. And the buyer said, that's fine. I don't care. I just need a place to have for my own. So at any rate, they do the deal. Now that's a monthly payment of $877.57 per month. And imagine for the next 60 months, like clockwork, very reliably, very accurately, that buyer pays on time. So that means the unpaid balance on the note is $96,574. And at this point, what happens is, let's imagine the seller one day needs money. One day the seller's situation changes where he needs or wants cash. And he calls up a company like Alamo Mortgage Holdings and says, hey, I got this note. I'd like to sell it for cash. So that means that that basically Alamo Mortgage Holdings could make an offer to purchase this. Maybe the offer would be, for example, up to $83,000. So they could get $83,000 in cash. So, and that's basically, if at a 12% yield, what would be the maximum offer? Okay, now let's talk about this, because those percentages, particularly for our friends in the UK, they may be sitting back thinking, who cares about that? I can get 10 or 12% in the UK anyway. I can get 8% if I look around. They may be thinking that. Well, let me point something out. There is a big, big difference between getting 8% in British pounds and 8% in US dollars. And Alamo Mortgage Holdings gives you the ability to choose which you want to receive in, or you can do half and half. So you can buy the bond in British pounds and be paid in British pounds, or you can buy the bond in US dollars and be paid in US dollars, or you can buy the bond in British pounds and have half of it converted to US dollars and half of it stay in British pounds. We can work with you. So now, look at the long-term history of the British pound versus the US dollar. Okay. At the Bretton Woods agreement towards the end of World War II, 1 British pound purchased 4 American dollars. Now, 1st of January 2023, 1 British pound only purchases a little over 1 US dollar, 121. So there's a big difference there. And if you travel around, if you've been, maybe you've been to America, maybe you've been to other countries in Europe, you have likely noticed how your British pound has less buying power than it did decades ago. So that's something that we can help you with. We can get you some currency diversification and some passive income. But please, when you're thinking about this, don't be sitting back over there thinking, oh, I don't need that. I can already get 8 or 10% in the UK. Think about that exchange rate also. I'm just asking you to think. I'm not suggesting what you do. Just think about it. Okay, so now let's take an example here. Let's look at packages of notes. And I've got a package of note. These are the types of packages of notes that Alamo Mortgage Holdings might purchase. And here's a video.
This right here is actually an example of what a portfolio of loan notes might look like. So this is actually a real portfolio. And you look here and you can see the name of the borrower, the number of months. You can see the interest rate. This debt is actually pretty high, 14.75% is what they're paying on that mortgage. The monthly payment is $278.50. Then you can see the terms, the status, this sort of thing. So, you've got a list here, and this is an example of a package where a package of these mortgages can be purchased. This type of deal would be done by a larger investor. It would not typically be a single investor that would buy this package. For example, my company, Alamo Mortgage Holdings, this is the type of package that we might actually purchase, something like this. But if you're just starting out in investing, you might start out by, you're just going to buy one mortgage note. So for example, you might come in and this mortgage note If you find something like this out on the market, you might try to negotiate down from, the unpaid balance at 89,570. Maybe you try to buy it for 59,000 or 69,000. But that would be one note. But you can also purchase packages of notes. And that's something that Alamo Mortgage Holdings is involved with. It's a company that's a United Kingdom company that actually purchases packages of mortgage notes. So wanted to give you an idea of what a package of notes look like.
Okay, very good, very good. So now let's talk about a question that I sometimes get asked: why bonds? I love this question. People say, well, there's so much inflation. Why in the world would I want a bond? I mean, I should go buy some real estate. I should go buy some cryptocurrency. I should go buy this. I should go buy that. First of all, buying real estate, if you've ever been a landlord and dealing with the tenants and the toilets, it is not something that is as glamorous as it may sound. And you definitely are not getting passive income. You're signing up as a landlord to work as a landlord. Or even if you've got your property manager, I assure you, you will be talking to your property manager on a regular basis about what's going on with the toilets, what's going on with the roof, and what's going on with the tenants not paying rent. We can save you from all of that. Now, the next thing about the cryptocurrency, every investor out there, they just love to burn their hand on that cryptocurrency stove. A bunch of them got burned on that Sam Bankman-Fried disaster. I mean, that guy was in there playing video games instead of actually paying attention to business, playing video games, but it sounded so glamorous that you're going to buy these cryptocurrencies. Look, I'm not going to tell you Benjamin Z. Miller's opinion. I'm going to talk about a Nobel Prize winning economist, Harry Markowitz, and what he did with his portfolio. So in 1990, Harry Markowitz, who won the Nobel Prize for economics, with his contributions to modern portfolio theory. And if you've got an account at BlackRock, if you've got an account at Merrill Lynch, I assure you that a lot of their portfolios are designed off of this modern portfolio theory. But that wasn't so much what Harry Markowitz did with his own portfolio. That's what's kind of interesting. He developed all these ideas about modern portfolio theory, but when it came to his own money, he did it a little bit differently. The way that he would do it is he'd put about 50% of the money in stocks, and he'd put about 50% of the money in bonds. And once a year, he would adjust that, where if the stocks had gone up a great deal in value, he would sell some stocks and he'd buy more bonds. Or if the stocks had gone down in value, he might sell some bonds and buy more stocks. A quote from him is, "I visualize my grief if the stock market went way up and I wasn't in it, or if it went way down and I was completely in it. So I split my contributions 50-50 between stocks and bonds." Now, folks, I want you to think about your own portfolio. What percentage of your portfolio is in bonds? What percentage of your portfolio is in bonds? And if it's less than 50%, you might want to think about this. Maybe give it some thought. So why Texas? Why Texas? Well, the nice thing about Texas is it is a state that is winning. We've got people moving to Texas from New York. We've got people moving to Texas from California. And this has the effect of making the value of the mortgage notes that we own at Alamo Mortgage Holdings even more valuable. Another reason we focus on Texas is because it is a state where it is so much easier to do business. Look at what happened with California, where Elon Musk moved out of California. He couldn't take the regulation. It was so annoying. New York, they have so much protection for people over there that you can't, they definitely are not on the side of the landlord, put it that way. So, but Texas is a great state where we can make money, and that's something that lets us pay that passive income to you. Okay, let's talk about the features of the bond. You can reach your passive income goals more quickly. Whether you're looking for an extra 5,000 pounds, 3,000 pounds, 8,000 pounds, 10,000 pounds, whatever you're looking for per month, or if you're an institutional investor, you've got some very larger goals. We can help you get there with our annual investment program, or if you have a large capital base, maybe you're an institutional investor, we can work with you very closely to make sure we get you taken care of. Maximum diversification. You remember the package of mortgage notes I showed. You are investing not in an individual mortgage note, which is the wrong way to do it. There's nothing wrong with doing it every now and then if you want to be in the note business, but unless you know what you're doing, you're going to do a lot better in most cases by having that diversification. No fees. We don't charge our investors any fees. Now, I know that some of you are probably talking to the hedge fund and the private equity guys, and I'm not giving those guys a hard time about their fees. I'm not saying they don't deserve their fees. I mean, I'm friends with a lot of guys. I'm just telling you that if you purchase our bonds, the money's not going to pay fees. So that is, we have a simple business where basically we are borrowing the money at 8%, and then we're trying to get a yield that exceeds 8%, which we can do quite easily. So we also offer interest payment flexibility. Okay, how does it work? Well, let's say you bought a bond that was 100,000 pounds, you'd receive 8,000 pounds in interest. If you bought our 5-year bond, you'd receive 40,000 pounds in interest and your 100,000 pounds back at the conclusion. If you bought a 50-year bond, you'd receive 400,000 pounds in interest and 100,000 pounds back at the conclusion. Okay. Who should invest in the bonds? Well, I believe that if you're the type of investor that is seeking an above average return on the investment, this will work. If you want the security of a note that is asset backed, and there's been so many disasters recently, just look at some of the things that have happened to people that didn't have asset backed things. And these are investors that should have known better. And I feel badly for them, because if they had just come to Alamo Mortgage Holdings and said, hey, you know, I want to get on your bond purchase program, I want to do some bonds with you, they wouldn't be in the mess that they're in now. But you just look at them, there's bodies all over the road. It's a shame. It's a real shame. And these guys are smart enough that they should have known not to do that. I feel badly for them. And then, you know, if you're looking for passive income, how long term is the note? We offer 3 years, 5 years, and 50 years. Okay, can I put the note into my self-invested personal pension? I see no reason it would not work well with a self-invested personal pension, but that is ultimately up to your SIP provider. However, if you talk to your SIP provider and they don't want to help you, if you kind of get the feeling that they really don't care and they're not interested and they're just going to give you some boilerplate answer, call us back, because we have SIP providers that understand this product. And we can put you in touch with a SIP provider that can help you. What type of an investment is it? You're purchasing a corporate income bond, a UK corporate income bond. Is it a regulated product? No, and that's part of the reason we can pay so much higher rates. Going through that regulation is such an expensive, time-consuming process. And yeah, I mean, if you want a totally safe product, you can just go buy a UK gilt and get yourself a 3.7% yield. But if you want something that has an actual chance of competing with inflation, Alamo Mortgage Holdings has a solution for you. Okay, who can invest? If you're the requirements are any individual who is over the age of 18 can invest, a trust, a company, a charity, a business. Come one, come all, we welcome you. How is the money protected? We have multiple layers of security and safeguards to protect investors' capital, which include upfront and ongoing due diligence. Can I invest through a company and are joint applications permitted? Yes, corporate investments and joint applications are permitted. Okay, very good. So how's the tax managed? We pay all the tax to you. We don't deduct anything. Everybody has a different marginal tax rate. We pay all the money to you. And then when you get the money, your interest payments, you can work out with your tax professional how much tax you should pay.
But we don't deduct that, and it would make it simple. Can you get access to the money early? No. And frankly, in this day and age, that's a benefit. And let me tell you why. A lot of these people that do that day trading where they, oh, I bought something and oh, it started to go down, I better sell it quickly, I'm going to show what a smart trader I am. They do that over and over and over again, and they rack up enormous fees, and it just wipes out their rate of return. With this, you've got a solid financial product. It's not going to be exposed to the wild volatility that you would get on a public or a publicly traded corporate income bond. I mean, a publicly traded corporate income bond, you could wake up one day, and if some newspaper stories came out, the value of those would drop immediately out of all the panic of, oh, I better sell that, you know, because there's an overreaction. With this, you're insulated from that due to the fact that we're a privately held company where you're not going to have to deal with that. How can I invest? It's so easy. Just contact us. Go to www.alamomortgageholdings.co.uk, fill out the contact form, let us know you want to invest. We'll get started on the paperwork. We'll get that over to you. We'll have some conversations as well to make sure that the financial product fits your needs. If you need more information, send an email to ben.miller@alamomortgageholdings.co.uk, or go to our website, fill out the contact form, or you can call me directly. I've got a US number +1 and then 817-203-4160. Okay, so that is it for our presentation today, folks. So now I'm going to stop the recording and I'm going to open it up for questions, but I want to thank everyone for coming. And again, I'll take questions now. Let me just stop the recording.